Go pull up your mortgage statement. I'll wait. This one is worth it because buried in that stack of line items, under the principal, under the interest, under the escrow, there may be a line costing you about $200 every single month. It's labeled PMI. And here's what your mortgage company is never going to call and tell you. You can legally delete that line, not lower it, delete it without refinancing and without touching your rate. There's a federal law that says exactly when that line has to come off. And there are two faster ways the most homeowners have never even heard of. I'm a licensed mortgage broker. I've been doing this for more than 20 years, and here's the plan for today. I'll show you what PMI really is and what it is quietly costing you. Then the ugly part, why the system defaults to the slowest exit there is about 8 years. And then the 3 escape routes that get you out years early. And stick around because near the end, I'll cover the one loan where all of this works differently. If that's your loan, you especially need to hear it. One quick favor before we dig in, tap the like button for me. It costs you nothing. It takes 1 second and it generally helps my channel. Thank you. And a quick note, I'm a licensed mortgage broker, but this is education, not financial advice for your exact situation. I'm using clean, round numbers today so you can see how the machine works. And your loan will have its own. Okay, let's go find that line. PMI stands for Private Mortgage Insurance. If you bought a home with less than 20% down, and most first-time home buyers do, your lender almost certainly attached it to your payment. And here's the part that makes people mad. So I'll just say it plainly. You pay for it every month, but it does not protect you. Not your house, not your family, not your equity. PMI protects the lender if you default. It's insurance on their risk, billed to you. If the worst ever happened, the check goes to the bank. You pay the premium and you get nothing, ever. Let's put real numbers on it. Say you bought a $400,000 house and you put 10% down. That means you borrowed $360,000, and we'll say the rate is 6.5%. Your principal and interest lands around $22.75 a month. Now the insurance. PMI usually runs somewhere between 0.3% and 1.5% of the loan per year, depending mostly on your credit score and your down payment. We'll use 0.7, right in the middle. On a $360,000 loan, that's about $210 a month. Call it $2,520 a year, every year. For coverage that pays you absolutely exactly nothing. Now here's the villain of this story, and it's not the PMI itself. Honestly, PMI is the reason you got the house with 10% down instead of renting for 5 more years while you saved up 20. That's a fair trade. Just make the normal payment and trust the system. Here's the path that's picked for you. There's a federal law called the Homeowners Protection Act, and it draws 2 lines on your loan. Both lines are measured against the original value of your home. The $400,000, it was worth the day you closed. Lenders call that an 80% loan to value. That's a balance of $320,000. And at that line, you have the right to request a cancellation. If you qualify, the servicer has to grant it. Line 2, when the balance reaches 78%, which is $312,000, they have to cancel it automatically. You don't even have to ask. Sounds reasonable. Until you watch how slowly a mortgage pays down in the early years, when most of every payment is going to interest. On the normal schedule, getting from 360 down to that request line takes roughly 8 years. 8 years at $210 a month added up, and that's right at $20,000 of insurance protecting somebody else. And your servicer is in no hurry. They're collecting. Nobody at that company is ever going to call and say, hey, could you stop paying us now? The default path is the slowest legal path. And it's the path almost every homeowner is quietly walking. Real quick, right here, because if you just did that math on your own loan, that feeling is the exact reason I make these videos. If something else clicked, tap that like button for me, please. And if you want the money side of homeownership explained straight like this, hit subscribe too while you're at it. Here's the honest reason I ask. This channel is small, and every single like and subscribe tells YouTube to show this video to the next homeowner who has no idea that line can come off. It's free, it takes 1 second, and it genuinely keeps these coming. Okay, here are 3 ways out. Escape route number 1, extra principal. That request line is just a balance of $320,000, and nothing anywhere says you have to reach it on the bank schedule. Every extra dollar you put towards principal moves you toward that line sooner. Round the payment up, send the tax refund. Depending on what you add, an 8-year wait can turn into 5 or 4. And every month you arrive early is another $210 that stays in your pocket. Extra principal is the slow and steady route, but there's a faster one. Escape route number 2, my favorite play in this whole video, the appraisal play. Everything on that default schedule is measured against your original value of your home. But your house probably isn't worth $400,000 anymore. Homes appreciate. And most servicers will also cancel PMI based upon your current value of your home. You just have to ask and prove it. Watch the math flip. Say your house is now worth $460,000. Your balance has barely moved. You're nowhere near the original value line. But measure the loan against today's value, and suddenly you're sitting on roughly a quarter of the house's equity. Here's the rule of thumb most servicers use. 2 to 5 years into the loan, they generally want to see at least 25% equity at the current value. 5 or more years in, 20% equity usually does it. The proof is a fresh appraisal. The servicer orders it, you pay for it, usually $500 to $600. Now hold that cost against the prize. One-time appraisal fee that deletes a $210 a month bill pays for itself in about 3 months. Everything after that is pure savings, every month for years. There is almost nothing else in this business I get to say that about. In escape route 3 is a close cousin. Substantial home improvements. If you renovated the kitchen, added a bathroom, finished the basement, real work that raised the value, most servicers will count that towards a current value to cancel too. Now, whichever route gets you there, there are 2 requirements, and I want you to write these down. First, request must be in writing. Not a phone call, not a promise from the customer service person, a letter or the servicer's own request form. That's what starts the clock. Second, a clean payment history. That means no payment 30 days late in the last 12 months and none 60 days late in the last 24. If your record is clean and your numbers hit the line, the servicer doesn't get to keep collecting just because they'd like to. The law is on your side. So let's finish the story the right way. You send the written request, you pay for the appraisal, and it comes to $460,000. The equity clears the bar, the payment history is clean, and the next statement arrives with PMI line gone. $210 a month back, $25.20 a year back. And here's the move that makes it beautiful. Don't let the money dissolve in your grocery budget. You've been living without it the whole time. Point it at your principal instead. That same $210 that used to insure the bank now pays your house off faster, which builds your equity faster, which pushes your balance further past the line it just crossed. The money that protected the lender starts compounding for you. And that whole transformation started with one letter. Now, before you go grab the phone, I owe you the honest broker moment. Because there's one loan where nothing I just said works. And I'd rather you hear me from than find out 3 weeks run around. If your loan is an FHA loan, the government-backed loan a huge number of first-time homebuyers use, you do not have PMI. You have something called MIP, Mortgage Insurance Premium. It sounds like a cousin. It's not. Different program, different rules. And here's the rule that hurts. If you put less than 10% down on an FHA loan, and most FHA buyers do, that MIP lasts for the life of the loan. No 80% line, no appraisal play. You can build up half the house's equity and the MIP stays anyway. For those loans, the only way out is the one thing this video title said you wouldn't need: refinancing a conventional loan. So if that's you, the honest answer is a refi check. Put your equity and today's rates aside side by and see whether the swap actually saves you money. Sometimes it clearly does, sometimes not yet. That's a 10-minute check, and it's literally what I do all day. And there's a link in the description to book a free call with me on my calendar. If you want me to run yours, I can do that. But everything else in this video, the 80% request, the 78% auto cancel, the appraisal play, that is for conventional loans. So check your paperwork. If it says conventional, everything you just learned is live ammunition. Here's the whole thing on one page. Find the PMI line on your statement. If it's there, you're probably paying roughly $200 a month to protect the bank, not yourself. The law draws two lines against your original value: request at 80, automatic at 78% of the value. The original value, of course. But don't wait 8 years for them. Send extra principal to reach the line early, or run the appraisal play. 25% equity at your current value if you're 2 to 5 years in, 20% after 5. Real improvements count too. Put the request in writing and keep the payment history clean. On an FHA loan, it's a different animal. That's one that deserves a refi check. And the day the line dies, aim that $210 at your principal and let it compound on your side of the table. And remember, this is education, not personalized advice. Your loan, your value, and your servicer's exact rules are their own. So confirm your numbers before you move. Now, before you go, I'll ask you straight. If this video just showed you to a $200 line you didn't know you can delete, hit that like button for me and subscribe to the channel. I don't say that as a throwaway line. This channel is small. Every single like and every subscribe tells YouTube to put this in front of more people. Quietly paying the bank's insurance with no idea, it can stop. That person might be your sister, your coworker, the friend who just bought the 10% with 10% down. So if I've earned it today, tap it, the like button, hit subscribe, and drop me a comment with 3 things. What you paid for the house, what you put down, and how many years in are you? I'll tell you straight which escape route I'd look at first. I read every single comment. Now, go pull up the statement and find that line. See you in the next one.